Okay, so today we'll just go over some kind of financial analysis tools that you can use. A lot of this does come from MGT 11A, so if you take an accounting, you'll kind of have an idea of what we'll already be talking about. So yeah, first thing we're going to be doing is kind of talk about like the SEC and how to find 10Ks of companies. So I'm actually going to go to a different screen real quick. And if you guys want to pull this up on your computer too, I'll walk you through how to do it. So first thing in web browser, you're going to want to go to sec.gov. And this is the website where most of the companies have to file to the SEC. So that's where you'll find everything. At least the public companies. Yeah. And now here, you're going to want to go to the company filings. It's at the top right. And here you'll be able to input the company ticker or the company name. So for our case, we're going to just use Apple. And you can just plug in the ticker or just put Apple in there. But yeah, once you get it, you can hit search. Shoot. Let me know if I'm going too slow or too fast. So yeah, once you find Apple, you'll come up to this thing, right? So this is basically where all their filings are. You got 10Ks, 10Qs, 8Ks, all these other stuff too. But for our purposes, we're gonna go to a certain date. Let's go 2014, January 1st, right? So we're gonna look at a certain 10K. So put this date in, so 2014 1/1. And here's how you can kind of search for a certain report that you want. So, okay, this is different than what I've used to before, but we're gonna wanna look for the October 30th 10K report. So it'll say filed on October 30th, and it should be a 10K annual report. Is everyone following for that? All right, so here's their 10K. That's how you find most companies 10 or all companies 10Ks that are public, at least. And yeah, so when you come down here, the important thing you're going to want to look at is the financial statements and the supplementary data, because that's where a lot of things we're going to talk about today is going to come from. You can look at the other stuff. There's a lot of notes about how numbers kind of come around, but for right now, we're going to focus on this part. And if you go to this in the table contents, it's on page 44. So I'm going to go there right now. And if you've taken MGT 11A, you're probably going to hate me when I say stuff like income statement, balance sheets, statement of cash flows, anything like that. Yeah, you probably just got PTSD to John Hancock in MGT 11A. Or maybe you liked him, I don't know. But yeah, so here you get you just have all the different, you have all the different statements. You got balance sheets here. Sorry, up there was the income statement. And then you got the statement of shareholders' equity. You got cash flows here. Everything that we're going to be going through right here is on page 44 through 47, 48, 49, somewhere here. So yeah, if you ever want to refer back to this, or like if you want to look at even another company's 10K, this is where you can find everything. So we're going to go back to the presentation now. And in case you didn't follow along, you go to company filings, look up the ticker, Apple, you'll find it here, right? And then you can look for its 10K. So the UI here is a little different than what we showed earlier. I guess they must have updated it in the last week or two since we did this slides, but you'll want to look for the 10K. It'll say it's an interactive data. And for this one, at least, it was filed under October 30th. And when you open the form, it looks different from each computer, but at least here, it looks like that. Again, on line 44 for the financial statements. And now we'll talk about like the income statement and those things.
All right. So for when you read an income statement and most things in financial statements, they're all going to be reading from the top down to the bottom. So think of it going line by line. Might be much easier to go along with. So when you start up at the top, it's usually always going to be either revenue or net sales at the top, depending what type of company you are. So the way that gross margin is calculated is you net sales subtracted by cost of sales. That'll give you the gross margin. And then we can go to the next slide. And then, so for calculating operating income, we will be taking the gross margin and we're going to be subtracting the total operating expenses. So I can just give you a second. I'll just whip out a calculator real quick and just see whatever number you get, and you can throw it in the chat. Just for the year 2013. So the first column.
I just want to answer a question in the chat. I saw Kelsey answered it too, but yeah, you should be able to get the 10Ks from other websites too, but I just use the SEC because that's more official and that's where everything has to be filed through at least.
Yeah, if you use something like Alpha Sites or use something else like Morningstar, that's all completely okay. It's all the same financial data. Just wherever you want to find it, that's okay, as long as it's the same financial data. Okay, so after going to the next slide, you can see if you got an operating income of 48,999, then you did it right. You know, do some subtraction, which is good. Hancock would be proud. And then if we just go to the next slide, we're just going to keep following. You're just going to go down one line by line. And then we're just going to keep going down. Net income will be operating income once you do some subtraction of other expenses or any additions. And then for an important equation, so next slide, one more. So the important equation, we're going to have earning per share. So this is calculated by doing net income divided by total shares outstanding. So here, if you go to the next slide, you will see we have net income, and then below it, we have basic shares that are outstanding. Now, when you calculate this, something important to realize at the very top, right below it says consolidated statement of operations. It says all numbers are in millions except for the number of shares, which are reflected in thousands. So when you do something, if you just did 37,000 divided by 925,000, you would get something like 0.04 or 0.004. That's not what you want. You're going to have to convert that into millions and then thousands, and then your calculation will work. So if you did it real quick, you should have gotten a value of about 40. So if you didn't calculate the millions and thousands right, you get something like 0.04, and then it would look really wrong, and your financial data will look really bad for your company. And then some other important equations that we recommend that you could use in your presentation are the earnings before interest and tax, also known as EBIT, and then return on equity. So the return on equity equation kind of shows how much after-tax income a company earned in comparison to the total amount of shareholder equity. And it's essentially telling you how efficiently the company is running. If the value is really low, it means the company might not be handling their money very well and they're making poor decisions. So then if we follow the next thing, the balance sheet is very similar to the way the income statement works, but now we're going to be following on with different kinds of items. So rather than seeing something like net sales, if you go to the next slide, we're going to see assets, liabilities, and shareholders' equity. And the main accounting equation that if you ever take an accounting course, they're going to preach to you is that total assets will equal total liabilities plus total stock or shareholders' equity or stockholders' equity. Those numbers are always going to equal. If they don't equal, then you might have messed something up. So when we're looking at this, we're just going to simply calculate top down. You're just going to add everything together to get total assets, and then you're going to do the same for total liabilities. And if you see in the shareholders' equity section under accumulated other comprehensive income, you can see that there is parentheses. Parentheses essentially mean subtraction. And I know this is kind of gross to look at, so I hope y'all aren't getting confused. This is just kind of like a little introductory. You can take this at your own pace when you're looking through financial data for the company that you're looking for. But right now, it's just kind of get you head start and kind of get you going.
Yeah. So most of this, we'll be posting the slides afterwards, so you can kind of like look back and get you can kind of get an idea. Like you can see how the numbers are obtained. Like you can just kind of add all these numbers up and you should get the total current assets. Or if you like do some addition and with these numbers, you can get the 207. So if you just have a calculator, you can honestly, after this presentation, run through a lot of these numbers and kind of see how they're obtained. We're going through it a little bit quick. So you can obviously, some things might be confusing. You might be looking at all these numbers and being like, holy crap, there's like 50 numbers on my screen. How do I do this, right? So sometimes you just have to come back and just really look at them. They're really not that hard. Most of it just flows very logically. You just add something to the next line or you subtract something from the next line. And then it's like the equations that we talked about. That's where the division and multiplication comes in. So honestly, if you just have a 4-function calculator, you can add or subtract most of these numbers and get them.
And does anyone have any questions so far before we keep continuing?
We know we're going a little fast. So if you want us to go back or like re-explain something real quick for anything, we can do that.
So if there's no questions, I'm just going to continue on with just some important equations. These are just other equations that you can include in your financial analysis about any company that you may be acquiring or maybe looking at about your own company. These are equations you don't really have to use, but we do want to see your analysis of financial data. If you choose to use something else entirely, that's completely okay, but we just want to see your reasoning behind it. We just don't want to see just some random ratio just because. Use something that fits the story you're trying to tell with the company that you're either acquiring or about the company that you were given yourself. So if we go on to the next slide, here we're just kind of looking again, just another chunk of the balance sheet. This is kind of just taken apart from what we were looking at earlier. This is definitely just so that you're not really swamped with a whole bunch of numbers. It's a lot easier and prettier when you're only looking at one column rather than 3 different years. It gets a lot more confusing. So then if we go down to the next slide, this one's going to look very ugly. But the statement of cash flows there's a lot to it, but again, it's actually pretty simple. It's simple addition and subtraction. You just kind of have to get understanding of how things go in order. And after a couple of walkthroughs, you do it, couple of look-throughs, whether you do it after our presentation later or just right now, you'll definitely kind of get the hang of it. And again, in case you haven't taken an accounting course yet, any parentheses around a number means you are subtracting that number. We don't use any subtraction signs or any minus signs. So most definitely look at that. And a big thing to see here is that when you're looking at the net income from a statement of cash flows, that actually comes from the income statement. So if you remember the net income that we had on the income statement here, we will be putting that into the statement of cash flows. So it's not only that the numbers flow from one column all the way down, they actually flow from one statement to another. And that's super important. And then looking at the next slide, we see here that, again, just a couple of simple addition and subtraction that you'll get all these numbers. But if you look at the middle column, September 2012, at the very bottom, you get a value of $10,000. If you see, that's the cash and cash equivalents of the beginning year of 2013. So those will carry over. So whatever your ending year cash and cash equivalent is, that'll be on usually December 31st of one year. And then January 1st, nothing has changed so far. So you'll copy that same amount for the beginning income. Does that make sense to everyone? Okay, a lot of you nodding your head, so that looks good. And when we're looking at the cash generated everything, again, that's simple addition. You start off with the net income, you add a lot of the operating income, and then whether it's either investing activities and you lost some money, so it's subtracted, you just all total that back up into the cash and cash equivalents by the end of the year. And then here, just like I was talking about, the ending cash in one year will be the beginning cash in another. So it's just going to flow from one year to another. That's how we get those numbers. And if you see, they're kind of coordinated with different colored circles. And another important equation that we say you could use is operating cash flow ratio. So it's a company's ability to generate the resources needed to cover their current liabilities. This is something usually generated in a small period of a company's income throughout their operations. For example, one company operation may be renting cars out, so they get a lot of service revenue. Another could be a clothes store, so they sell a lot of items. That's their operating inflow. Operating cash flow changes depending on what industry you're in. A bank getting interest revenue would be an operating cash flow as compared to maybe a secondhand store getting interest revenue.
All right, so now we'll talk a little bit about forecasting. This is kind of an introduction to forecasting. Yeah, tune in next week so you'll actually get a little more in depth on how we forecast. Yeah, I'm just gonna let you guys look at this for a minute and tell me how ugly this is, because you're probably looking at this and you're like, what the heck? All right, so let me explain this. So 2011, 2012, 2013, all these numbers in blue right now, we just took that directly from the 10K statement. So if you actually like look at some of these numbers, you'll kind of recognize them, like the 37,000 from net income before, the 40.03 for the earnings per share. Yeah, I'm just gonna move on because I don't want to look at this either right now. So let's just look at this. This is actually what I just said. It was from the 10K. So breaking it down a little bit more. This was all done in Excel, by the way. So I highly recommend Excel. Google Sheets sucks. Yeah, so we have revenue here, and we just wanted to do a little bit of percentages. So one thing that's good to highlight is like the revenue growth from year to year. And here, if you just do 156 minus 108 divided by 108, that's 44%. It's just percentage change. Again, you can also get other percentages too, like the gross profit as a percent of sales. You would just take the gross profit divided by the revenue. You can quickly just use your calculator for function, and you can get all these numbers as well. So when you guys look back in the slides, we've highlighted all these numbers for you. So when you look at them, they should be pretty straightforward as to how we got each percentage. Again, tax rate as well. You just take the taxes and then divide by the pre-tax profit. And now we'll talk a little bit about forecasting. So I'm not going to get too in depth as to why we decided to choose certain percentages. We actually took these from Raymond James equity research report. So if you guys want to go out and like look at some equity research reports, you can just take their kind of projection. A lot of forecasting does come with an understanding of the market and like understanding of what the companies in that kind of market do. And since we're not really well versed, I don't think anyone here is super big on one certain part of the market and totally understands how it's going to be forecasted in the next 5 years. I just decided to steal some numbers from Raymond James. Yeah, so they decided to forecast revenue growth at about 5%. So that's kind of what I put in here. And this 5% growth should reflect into here, right? So we'll take the previous year's revenue, grow it by 5%, and then it'll become 179,000. You guys can use your calculator and kind of get an idea of how this goes. But same with everything else, right? We forecast a certain amount of growth as well. And then here we actually take the revenue and then we apply some more subtraction to it. And we'll talk about we won't really talk about how we got these numbers, but they do come from the forecasting, the percentages. We won't talk about that in this workshop, but we'll next week, they should go more in depth on how this kind of forecasting goes. Some of it, you can kind of just look at previous years and get an idea. Oh, it probably follows about similar year to year, but that's just eyeballing it. So yeah, then we want to take those percentages. And if we want to forecast it, say 5 years, you just take the 5%. And what I love about Excel is you just drag it across and the equations just go, right? And then here, again, you can see how it kind of grows at about 5% each year. Gross profit stays about the same because we're using same equations-ish. Research development, SG&A, and then taxes, we just kind of keep those percentages. Again, if you want more in depth, go look up a equity research report. They'll give you more in depth. They'll probably go into like notes about why they chose certain numbers or more understanding of the market. I'll actually post the Raymond James report that I took most of these numbers from at the end of the workshop. So I'll edit the slides before I post them too. And yeah, so when you're projecting numbers, again, would you rather look at something like this, or would you rather look at something like this graph? So you obviously want to look at something like this graph because it's more appealing. It tells a better story than 50 lines of numbers, right? And for cash flows, again, we're going back to what we said previously. Net income, you want to put that into the cash flows, and then you adjust it based on all these non-cash assets. you'll get a lot of these cash from operating and cash from investing. And then, yeah, you just forecast it year to year. You take the next income and then you go forecast it to the next year. You bring it to the statement of cash flows. Yeah. And then again, so operating, investing, and financing activities, we forecast it like that. So here's just kind of example. Again, most of these numbers are taken from the equity research report. So I will link that so you guys can refer to that as well. And then balance sheet, cash and cash equivalents, you'll want to take that number and then adjust it based on all the operating, investing, and financing activities. And then see here, if we want to take a look at the first balance sheet. So for 2014, it's 152,000. And then in 2015, the net cash, or like for 2015, the net cash during that period was about $8,000. Since cash flow represents a period of time, while balance sheets are just a snapshot at that specific time, you would add the $8,000 from that period to the snapshot at 2014 to get the snapshot at 2015, which is 161,000. Again, you can add 161 to 8,000 and you get about 169. And then just reiterating that. So yeah, but depending on the equity research reports as well, some of these assets may stay the same from year to year. Again, I just kind of took them from the Raymond James equity research report. You can kind of take a look and see why they value things at certain numbers. And yeah, that's it. I will link the report at the end of this here, so you guys can get a little better understanding of how we exactly forecasted. I know these were a lot of numbers, and some people are probably very confused looking at these numbers and how exactly things flow from statement to statement. But I think I hope I laid out a lot of the, at least with the arrows and the circles, to where you can kind of get an idea. If you guys have questions later on, you feel free to DM me and Chance, and we'll try and explain it a little more in depth as well. And yeah, that's the end of our workshop.
Thank you, Kevin and Chance. You can stop sharing your screen so Brandon can take over. And we are recording this. We will send it out, as well as all the workshop slides. And your team should have varying amount of experience as well with the information that was presented today. All right, without further ado, I'll let Brandon take it away for our second workshop. We may run like 1 to 2 minutes over 7:30, so just try to be patient with us. Okay, go ahead.
Cool. Can everybody see my screen? We're good? Yeah. All right, cool. So, hey everybody. So we're gonna take a little bit of a break from some of the more nitty-gritty finance stuff. And we're gonna go through some ways to display your data in your case comp presentations through the means of data visualization. So let's make some pretty pictures. All right. So before we even start, what is data visualization? Data visualization refers to the ways in which we communicate data through visual means, whether those are graphs, charts, maps, or anything else. So as alluded to in the slide before, here are some common types of data visualization you guys are all already familiar with. We have charts, tables, maps, graphs, as well as infographics and dashboards. There are a ton of other forms of data visualization and subcategories as well, but these are the most common ones you'll run into. So in order to know how to make graphics to visualize your data, you need to have a place to start. Here are some free data visualization resources you all already have access to. If you've taken PLS 21, you're already familiar with Excel and Sheets, but these platforms are pretty simple compared to the rest of the things on this list. Here we have Tableau Public, Chart Blocks, and Infogram. They're all some of my favorites. They each have a free plan that should accomplish your needs in regards to making your case comp presentations, but they also all have premium tiers should you need an extra degree of customizability. So in today's workshop, we'll examine data visualization through 3 lenses or keys, with those being an emphasis on effectiveness, clarity, and design. If you focus on all 3 of them during your presentation, should be Gucci. So here we're going to start with effectiveness. The goal of displaying data in presentations or research is to convince somebody to do or believe or support something. Like Vish said before in the earlier workshop, you're trying to tell a story. You should ask yourself throughout creating your graphics, am I accomplishing my objective? If you think your data will convince somebody to support your stance or perspective, then you're on the right track. So the first thing, it's a bit of a no-brainer, but use the right type of chart for your data. understand the strengths and intended uses for each type of chart or tool. One of the biggest violators of charts and data visualization errors are pie charts. Pie charts are always tricky due to how easily you can just easily misuse it. Just know that pie charts are used to compare parts of a whole group, or it's used for proportions, while bar graphs are used to represent differences between groups. Remember that for later. So here's an example of using the wrong type of chart. Here we have an American's desire to have children in the years 1990, 2003, and 2013. Let's look at the orange circle for now, the one all the way on the far left, even though all four of them are kind of just bad examples of data visualization. So when looking at a pie chart, your first assumption is that it should equal 100% because a pie chart indicates proportions. But here, if you look at it, we have 73%, 72%, and 74%, which according to my calculations, definitely does not equal 100%. So this then prompts the reader to have to actively think and interpret what the pie chart is trying to tell us, which immediately lowers its effectiveness. The second you have somebody having to think twice about what you're trying to tell them, you're already down the wrong road. So another tip on effectiveness is to try to strategically choose which information you want to display. When creating data visualization tools, you're trying to tell a story. Highlight information that really emphasizes the point you're trying to create. So for example, if I'm talking about business profits, say from 2017 to 2018, and there was an increase, that'd be an important point to notice. But you can change the scope of your graph, and then the meaning of the graph will also change if you show some contextual information. So for example, you can show a steady upswing over several years, or if you have like a down quarter, it can show your company's ability to jump back and recover from it. In our last point on effectiveness, planning how you order your data is very important. And this kind of begins our crossover into clarity. Think hard about how you order your graph and also how people regularly view a graph. Here we have two graphs, one with several ordering problems that significantly hampers its effectiveness, labeled by incorrect. The first ordering issue is probably the most obvious one and probably a little exaggerated, but if you look on its axis, it's ordered by average, then awful, then excellent, then mediocre. You guys can probably all understand why that's wrong. So you should have your categories in a descending or ascending order. And what you also may want to focus on too, though, if your data permits, is to look at how your graph is organized aesthetically. On the left, if you see there, you have to constantly have your eyes jump from right to left and left to right because it's going from 30 to 15 to 45 to 10. While on the right side, your eyes just glide from one corner in the 45% range all the way down to the corner on the bottom in the 10% range. It's definitely not possible to do this for every data set you come across, but when it works, it looks really nice. But let's transition over to clarity. This is pretty similar to effectiveness, in which the reader needs to be able to look at and immediately understand your chart or graph without struggling at all. When adding each new number, graph, or color, ask yourself, can I read all this? So for the sake of time, we'll focus on just one aspect of clarity that is the tip that I always see the most when researching data visualization, which is including a zero baseline. A zero baseline on something like a bar graph is, as it sounds by the name, is having your graph start from zero. Zero baselines create a starting point for your data that helps establish perception for your reader. Starting at some random data point will create confusion and hurt your data. Not using a zero baseline can also lead to showing bias if used intentionally, even if the numbers themselves are unbiased. So speaking of bias, this is something you might see today, but here's an example of not using a zero baseline and how you can manipulate real numbers to further a story that may not be completely true. Here's an old bar graph that was used in late 2012, and it talked about how much the tax rate would rise if tax cuts that were created when George Bush was president expired. In the graph, it shows a huge increase from the yellow bar on the left that says now, and then the one on the right. If you look at the numbers themselves, it's not much of a huge rise, but it looks like it's a huge difference. But really, it's only a 4.6% difference between now and then 2013. And the reason it looks like such a huge increase is because it starts at 34% on one, and or if you look on the axis, on the baseline, it starts at 34% and it ends at 42%. If this graph had its axis go from 0 to 100%, it'd be a very minuscule difference and not support the message they're trying to tell at all. So when people who are probably biased and they show you a chart full of numbers, make sure you pay attention to how they try to steal your perception of things. But moving on from clarity, let's focus on the fun part of data visualization, which is design. While a lot of designs look simple or just have extra pieces to make it look pretty, every element or feature you add should have intention behind it. You should be able to ask yourself, is what I'm doing adding or detracting? So one important thing to pay attention to is color. Color is a huge part of data visualization and can actually completely derail the clarity and effectiveness of your graph without you even realizing it. The first important thing to take note of is color associations. Colors have meaning behind them, and one of the most obvious meaning and color associations is red and green. You don't want to mix those up. Red is negative, green is positive. And if you look at all the other colors on the color spectrum, they should all have meanings associated with them. So just take a second before you add a color or you assign a color to an item and just think if it's going to confuse anybody. Another thing to take note of is using colors that contrast from one another. It might look nice to have a bunch of shades of blue on a pie chart, but it isn't too great if you want to highlight how different each statistic is from one another. Third, use color appropriately and sparingly if you can. Try to avoid using more than 6 colors, or else it may start looking a little bit confusing. Nobody wants to look at a presentation or a chart and just have color vomit all over the screen. And then our last tip on design is to keep it simple. It may be tempting to throw in some fun effect, it might make it look pretty, but a lot of time they come off as distracting. Avoid drop shadows and 3D effects. Also, it's important to label and point out important information in your graphs for clarity, but make sure you don't over label either. Nobody wants to read a graph where there's so many labels that words start to overlap each other. You've done econ homework in my labs where you have to like fill in charts on a graph and there's way too many numbers and shapes on it and it starts to overlap. It's not pretty. So now that we've gone over a number of tips on data visualization, let's put some of that knowledge to use. Here we have a fake generic soda brand that is conducting market research with completely fake numbers that I made up. They set it up so they are measuring the percentage of users who have heard of their brand on Twitter, YouTube, and Twitch per 1,000 people. There are a couple large mistakes that use what we learned regarding effectiveness, clarity, and design in this presentation. For the sake of time, let's move forward a little bit and then just see what the issues are. So while there are probably a ton of different ways we could improve this chart, here are the 3 issues that I decided to focus on here. First off, the key being that far away from the graph and having just straight numbers on the chart itself creates confusion as we as readers try to connect which statistic matches each platform. You have Twitter all the way on the left, and then you have 3 numbers over there, but you're not completely sure which number coordinates with what. And on top of that, the use of color isn't helping things out either. We have blue, a teal, and a turquoise. While it's really pretty on the eyes, it's hard to discern what any of this means or if we're supposed to actually notice anything from this. And then finally, what I think is the biggest offender, which I alluded to earlier in this presentation, that we're using a pie chart to represent data from different sources. We have 48%, 35%, 57%. And I'm no math genius, but I'm pretty sure that does not equal 100%. But then the question now is, what changes could we make to improve this? So here is a redone version that I made. I made this in Infogram. Shout out to that platform. But adding a clearer key, better coordination, and a bar graph. What I want to particularly emphasize here is that we're really utilizing color coordination, as these 3 brands have all become very discernible from just their colors alone. So you have the blue with the Twitter, red with YouTube, purple with Twitch. Shout out to their marketing teams. And then with a change in graphs and just a couple color changes here and there, this data just became so much more informative than what we had before. So to summarize, we have 3 keys: effectiveness, clarity, and design. With each key, we had a core question attached that should guide us through creating our graphics. And if you keep all these tips in mind when creating your case comp presentations, it may even help your own understanding of the subject material. So That's all for me. But if you have any questions, you can unmute yourself unless we're out of time. Yeah, it looks like we're out of time. So you can throw some questions in the chat, or you can send me a message on Facebook or Discord if you want some more info or tips on data visualization.
Yeah, thank you so much, Brandon. I know we're at time, but we still can hang on for any questions that you might have. If you have to drop off, you can go ahead and do that. We'll be sharing all of this information out in the newsletter.
So I had a question about the GM meetings.
Yeah. Hey, Rubayat, what's up?
So do we have a different Zoom link each meeting, or is it the same link?
It's the same link.
Thank you.
Yeah, you're welcome.
All right, Kelsey, I got to dip too. I have a homework meeting.
All right, that's fine. Thank you so much, Kevin, Chance, and Brandon for leading workshops today.
All right. You should probably stop the recording too.
Oh, yeah. Oh, that's awkward.
Yeah.